After being very positive in Q1 on global equities and buying into the reflation trade and the pro-growth Trump policies, we're turning negative here in Q2. But we're coming off a spectacularly good quarter for global equities with very strong performance, outperformance among emerging market equity markets, driven partly because the dollar didn't rise as expected in Q1, and that has eased condition in emerging markets. And basically now we're seeing a hunt for yield, a hunt for risk, and that goes into the emerging markets. But we think the reflation trade is ending here. There will still be a positive impulse from Chinese producers. There's around 8% gain in prices from Chinese producers, but the big one has been from energy. The oil prices have rebounded significantly from a year ago. But if we assume no change in the oil price, the base effect, the impulse into global inflation will go to zero by the end of June. And that, I think, is the big cause for concern here in equities, because the equity rally has been driven by this reflation trade, and we think it will end here in Q2. And with that, we expect underperformance among financials, material sectors, all the cyclical ones. So basically, you will see a flip of the out and underperformance from Q1 into Q2. So we expect emerging market equities also to underperform as the risk is coming off the table. The only sector which we really believe can continue its outperformance is actually technology stocks. It's the only true pocket of growth out there. It's the only really good growth component you can add to your portfolio, and as a result, we think investors will continue to turn the blind eye on the valuation and take this sector higher. We also highlight in our Q2 outlook that valuations are historically very high now in US equity markets. That's really something that is worrying us, and also why we're favoring European equities over US equities. The valuation premium between US and European equity markets are now 20%. It's the highest since 2011, and it's really one of the main drivers why we think European equities are attractive here. And also the growth is higher in Europe for the moment. If you take the Eurocoin, the real-time GDP indicator on the European economy, it's growing at around 3% annualized, and that's really something that we think will begin filtering into earnings results as we move into Q2 and Q3 and Q4. So as a result, we go with the European equities. And finally, we also have yet again a theme on energy. We think energy should be underweighted here. We think there's really reasons to be concerned. The capital structure, the level of debt is really high. It's historically high, the highest it's been since 1995. And the operating profit cannot sustain the capital structure. And since we don't believe oil price will move high anytime soon, we think there could be some pressure in the refinancing, and we can already see it. The high yields on energy companies are already turning higher this year.